Welcome to your CIMA P1 Management Accounting course with Practice Tests Academy. Hope you're looking forward to dipping into the world of management accounting as much as I am. We're going to start off by looking at the rationale for the subject really, and the rationale for costing and management accounting. So this is a fairly sort of definitional introductory chapter just to position the subject in our minds before we launch into the detail. So first of all, we've got cost accounting and management accounting. Cost accounting is a subset of management accounting. Cost accounting is about gathering cost information and working out the cost of things. And that's known as a cost object. So it might be the cost of an item you produce or the cost of a department and so on. Management accounting is a broader discipline than that. So cost accounting focuses on gathering information on cost. It's purely quantitative, tends to look at what you're producing right now. Management accounting is much broader. It's producing information for decision making, part of which might be cost, but there's other things as well. Revenues, what demand might be, stakeholder analysis, what other people might want from the organisation. It's a very, very broad discipline and will include not only numbers but words as well and opinions, and will involve short term, yes, but also the longer term. So management accounting will help management to decide on things like, should we invest in this new factory? Should we launch this new product? Now, financial accounting versus management accounting. A good analogy I once heard about this was imagine there's a car, right? There's two people in the car, one driving and one in the back seat. The financial accountant is the one in the back seat looking out the back of the car, and he's very good at describing to everyone, so lots of external users, describing to everyone stuff they've just gone past. So financial statements that are produced by companies help to explain in a standard and coherent way what's happened in recent times. The management accountant is the one driving the car that's helping to make decisions about where to go, which lane to be in, and so on. So they provide information for management as opposed to producing statutory accounts. And because it's internally focused, not externally, there's no rules and regulations. There are principles and logic to follow with management accounting, but with financial accounting there are prescribed rules as to how things should be treated and presented. So management accounting is to help management with planning, so putting budgets together, for example, for the next year, saying this is how much money we need to spend next year. Control, so comparing actual to plan, that's known as variance analysis. So if I have a plan for the year and as I'm going through that year, I gather information on my actual costs, let's say, I can see my actual costs are overrunning, then a management accountant will do some analysis for me to help me understand why that's the case. And also to make decisions like, should we invest in this new product? Should we hire this new member of staff? And you can split those types of decisions into operational, so day-to-day, strategic, very big picture and long-term, and then sort of everything in between, tactical information. So maybe month to month, should we employ more staff, for example. So the management accountant, the role of the management accountant is quite broad, and it's got broader over time. In the past, the management accountant was very much seen as a scorekeeper, someone that kept track of the cost of things, for example, and reported results internally. They were the numbers people. Whereas these days, management accountants are all about enhancing performance, helping decision makers to make the business run better. So they'll do some interpretation of the numbers, work alongside business leaders to give them the information they need to make their decisions. It is part of making the organisation run better, therefore part of the senior management team and part of senior decisions. Now, there are lots of reasons why, having said all that, understanding cost at a base level is still a very relevant thing to organisations. It helps us to understand how much inventory we've got and how much it's worth, to calculate profit, because profit is revenues less cost, to set prices. So quite often organisations set prices based on the cost of making an item and add a bit on to make some profit, and that comes up with our price. And to help make decisions, so understanding how much various different course of actions will cost, will help inform decision makers. It's also relevant to think about what drives cost and to focus on where costs come from in the first place. This is known as the cost transformation model. And the idea is that focusing on cost and what drives cost helps to encourage a culture that ends up with cost control and then better competitiveness. So if we're giving visibility to the activities, for example, that cost a lot of money, then we will seek to minimise those activities if they're not giving us any competitive advantage. Now, some definitions to finish on. We've got cost unit is something against which you're trying to ascertain cost. So it could be a product that you're producing or an hour of service you're producing. A cost centre is a place where you're trying to associate costs. So you might have the canteen in the corner of the factory could be a cost centre, where you you try and work out the costs of running that canteen. So it's a collecting point. It's a type of responsibility centre. And a cost object is a product, service, centre, activity, customer or distribution channel in which you're trying to ascertain cost. So a cost object is anything that you're interested in the cost of. And a subset of cost objects are cost units and cost centres. So cost object is anything against which you're trying to ascertain cost. Two examples of which is something you're producing, a cost unit, or a place in your factory, let's say. That would be a cost centre. Costs can be divided up or classified by behaviour. So do they change when we produce more? If they don't, then it's a fixed cost. If they do completely, then it's variable. If they do a bit, then it's semi-variable. More on this later. By elements, so it could be, is it materials? Is it labour? Is it other types of cost or expenses? Or by nature, they may be directly incurred as a result of making an item or indirectly incurred. So if we use some material to make something, that would be a direct cost. If as a result of making something we later might need to maintain some machinery, then that would be an indirect cost of making that item. Okay, so welcome to Management Accounting, guys. That's a brief introduction to set the scene for management accounting. And the core concept to me is to think of management accounting as a forward-looking, value-adding, decision-making type discipline. Okay, what I suggest you do is start having a go at the questions after each and every chapter you've had a look at. So as we go through the course, what I want you to do is to, after you've watched the video, read through the chapter in your own time, then hit the question bank and do as many questions as you can before you move on to the next chapter. In the meantime, thanks for listening.